generally speaking, the sweet spot for Roth conversions that we've seen is that 22-24% tax bracket. We very rarely do anything in the 30s. Just doesn't make sense. But because of that, it's spread out over time. Now, we have to talk about coordination with a CPA. So I'm going to give you an example. Mr. and Mrs. Customer decide they're going to do a Roth conversion. It's going to be in the first year, they're going to take $200,000 out of their IRA and they're going to convert to the Roth. How do we know that it's $200,000? How do we know the amount?
We work a lot with the CPA, and since we're a level 5 advisor, we can just go down the hall and talk to our CPAs. How much can we convert to keep them within that tax bracket that we have set for them?
Yeah. And so is that pretty easy? Like we have CPAs here. So how does that work for you, Andrea? Talk me through it.
Yeah.
I'm a customer. How does that work?
Well, literally the office next to mine is a CPA. So I just walk in there and we have a discussion about this particular client and what tax bracket they need to be in. And, if we can convert 200,000 for your example, then they have to pay 40,000 in taxes. And then the logistics of that,
Right.
Are we able to use a taxable account? Are we making estimated tax payments?
Right. So let's be clear. We said maybe a good strategy might be to do a Roth conversion, but keep you under the 24% tax bracket. What that number is, it could be $190,000. It could be $210,000. We don't know how much are you going to convert to keep you under that 24% tax bracket.
Mm-hmm.
The answer lies within your tax return. Unfortunately, you have to do the conversion in a calendar year. We don't know what your tax return is going to look like. So we need a CPA, generally November, early December timeframe, who knows what your tax return is going to look like so they can tell us this is the amount that we need to convert this year. It helps if you have an advisor with CPA sitting there. Otherwise, what are we doing? We're trying to talk to somebody's outside CPA.
Yeah.
It's just a nightmare. And you touched on it. So let's be clear. When you convert $200,000, if that's the number, there's a tax bill associated with that. Let's say it's $40,000. There's two ways that you can pay that $40,000. What's the first way?
The first way is you can just move $160,000 into your Roth from your traditional IRA, and that $40,000 goes straight to the government.
So $200,000 sitting in your 401k on day one. You do the $200,000 conversion. The next day you have $160 in your Roth, and $40 has gone to Uncle Sam, which is not as good as option 2, which is what?
Taking the money out of either a bank or a taxable account and paying the tax bill so that total $200 moves into the Roth.
So now you have the full $200 that's been moved from your 401k or IRA into your Roth. Now you're maximizing the benefits of a Roth. Now you do have to have a checking account or a taxable investment account with $40,000 saying not everyone has that.
Yeah.
But the more money you have sitting on the sidelines to pay the taxes, the more you can maximize the Roth benefit. And of course, it goes without saying, your tax return, if you do a Roth conversion, there's special forms you have to fill out, but that's just some of the details that people ask about. What does the tax return look like? It has an extra form on it.